So welcome to our second review session. Since there are not many students here today, so I would encourage you to ask as many questions as you want, because so we can have a more a detailed discussion on the stuff you are interested in. So today we're going to go over 6 and 7, the bond, valuing bond and stocks. So those knowledge are based on chapter 5, right, that we have already done. And we add some more concepts on it, build on the techniques we have learned, the time value of money, and we are using these techniques to value financial securities, bonds and stocks. So similar as last time, I will quickly go over some important knowledge, followed by the questions in our question list. A little difference today is after each important principle that I will go over, I will follow up with a question that is in our question list. So these are better matched together. So what is a bond? Bond is a security. It's a fixed income security, that obligate the issuer or the borrower to pay a periodic payment for a period of time, a finite length of time, and a principal payment at the very end. So we call that fixed income because the payments are fixed. The payments are fixed when the contract has been signed, the bond has been issued. We know how much the issuer or the borrower are going to pay during the time period, each period, and we know the final principal payment. But if we already know the payment, we still need to value it because of what? Because of the time value. Right? We know there are fixed payments, a bunch of fixed payments in the future, but we don't know how much those payments are going to be valued as of now, based on the discounting rate, based on the market interest rate that we require. So we still need to value those future cash flows. That's what we do in the chapter 6. Face value is the principal. Usually it's 1,000 in the context of our textbook. It's always 1,000. Coupons are the periodic payments that made in each period in the future before maturity. They are also fixed. We call that the interest payment or coupon payment. And coupon rate is just the periodic interest payment divided by the face value, usually 1,000. The coupon rate. And this is annual. Say this bond is semi-annual payments. Make semi-annual payments, 2 payments a year. So what we do is add them up. Annual payments, interest payment divided by 1,000. The interest you receive in the whole year divided by 1,000. And what I want to say is all these terminologies say interest payment, coupon payment. Coupon payment, these are all fixed. All these are fixed when the contract was signed. So whatever happens after the contract, these are all fixed. So if we ask, what happened to the coupon rate of 1,000 face value bond that pays $80 annually in interest if market rates change from this to this? Stays the same. The coupon rate remains at 8%. The coupon rate is set at the signing date of the contract, signing date of the bond. So coupon rate measures the coupon payment as a percentage of the bond face value, and therefore it's fixed. However, interest rate changes from day to day. And these changes affect the present value of coupon payments, but not the payments themselves. The payment stays at $80 a year, but the present value can change, based on the market interest rate in the future. All right. Question. So answer C. One of the greatest. There's 2 of the greatest risks that a bond buyer or bond investor face is default risk and interest rate risk. We start with the interest rate risk. What a risk is, that is something that's going to affect the future value of this bond, right? And how interest rate going to affect the bond price? Because each coupon payment or cash flow in the future is fixed. If we require a higher interest rate, Okay, a higher interest rate, we call that market interest rate. If the investor require a higher market interest rate, those fixed future payment gonna be worth less today, right? So the price or the value of these fixed future payments gonna be less, okay? So in the conversely, in the opposite, if the interest rate, market interest rate goes down, meaning that okay, currently the bond investor require a lower market interest rate, lower return on these bond. That means those fixed future payments gonna be worth a little more. Okay, so the price of that bond is gonna be worth a little more. It's gonna be higher. Okay, so when interest rate rises, the present value of the fixed payments in the future gonna be reduced. Okay, so the bond price is gonna fall. Right. Conversely, if the interest rate increases, okay, a decline. If the interest rate declines, if the interest rate decreases, it increases the present value of the future fixed payments. So the bond price goes up. Okay, so there is a reverse relationship between market interest rate and bond price. Interest goes up, bond price goes down. If interest goes down, bond price goes up. Okay? All right. Let's see this. Second, consider a 3-year bond with a par value of 1,000 and an 8% annual coupon. If the interest rate change from 8% to 6%, so the market interest goes down. Okay? So the bond price will go up. But go up by how much? So we are using the present value calculation, right? So they are all 3 years. N equal to 3. And the PMT is the periodic payment, right? It's 1,000 multiplied by coupon rate, $80. They are the same. Future value, principal payment, same, 1,000. And only difference is, okay, interest rate changed from 8 to 6. Originally, present value is 1,000. Okay. Now the interest rate decreases to 6. Okay, present value increase a little bit, 53, 46. Okay. So the price will go up by the difference. Right. So I will not do this on the calculator. It's pretty simple. Just input these variables and you get the answer. Right. Okay. With this reverse relationship, there's a threshold that determines whether the bond price is going to be higher than the 1,000 face value or lower than the 1,000 face value. And that threshold is what? Is the coupon rate. Okay, the coupon rate. In the previous example, it is 8%. You see, okay. If the interest rate is equal to, let me be more precise. If the market interest rate is equal to the coupon rate, then the bond will be priced at the par value or the face value. And this is what we observe here. 8% annual coupon rate. And the interest rate, if it is 8%, is equal to the coupon rate, then the bond price will be equal to its face value. And then if interest rate, let's say in this case, decreases, okay, decreases from 8 to 6, then its price gonna be higher than the face value. Okay, interest rate goes down, price goes up, goes above 1,000. And same thing in the opposite. If interest rate goes up, the value of the bond or the price of the bond goes down, which is below the face value. Okay, so that threshold is the coupon rate. Okay. The market interest rate exceeds the coupon rate, bonds sell for less than the face value. When it's below the coupon rate, bonds sell for more than the face value. Right. Okay, let's see this example. The Franklin Company issued a 6% bond 3 years ago at par value. What can we know from that sentence? The interest rate, the market interest rate 3 years ago when the bond was issued was 6%. Okay, because the bond was issued at the par value or the face value. Now the market interest rate on the comparable bond today is 5%. Comparable means what? Very similar, everything the same, meaning that if the interest rate on that bond is 5%, we should also require 5% on this bond because they are comparable. The investors require similar or even the same market interest rate. Okay, so that sense implies that the market interest rate on this bond today is 5%. So currently, okay, so that 5% is lower than the bond the coupon rate, right? So it should be sold at premium, okay? And currently pays how many dollars a year? So 60%, 60. Okay, so that's 60 sold at premium. Okay, pretty simple. Question? Yeah.
How do you get to 60?
60 is annual coupon, right? Pays how many interest a year? That's annual coupon. It's 1,000 multiplied by the coupon rate. So that coupon rate is 6%. Okay. Right. Not used at all. The 5 is used to judge whether the bond is selling at a discount or the premium. It's not for the calculation, right?
Wait, how do you determine discount or premium again? 1,000 times 160. No, but whether it's a discount or a premium? How do we know it's not A?
If the market interest rate now is lower than the coupon rate, then the bond should be priced at premium. It's higher than the face value. Okay. Yeah.
In this case, if it would be 7% instead of 5, it would be 60 on discount.
Where 70 come from?
No, the 7, instead of the 5% would be 7% down.
Yeah.
Then it would be 60 on discount.
Yeah, that's right. Yeah, good. Right. Okay. Now, since interest rate is a risk to bond, but bonds may be subject to a different extent of interest rate risk. Okay. So what bond is more subject to interest rate, or what bond is facing more interest rate risk? Okay, let's look at this. All these sentences are from our textbook, so there's an original sentence that we can use. Okay, a change in interest rates has only a modest impact on the present value of near-term cash flows, but a much greater impact on the value of distant cash flows. So we know this, right? If we receive $100 a year from now versus 10 years from now, a change in interest rate is gonna have a larger impact on that $100 that we receive 10 years from now, right? It's further from now. We need to discount that $100 by 10 times, and if interest rate change, then the change is gonna be for 10 times, right? So the effect of the interest rate change is gonna be higher for distant cash flows than for near-term cash flows. Higher risk, right? Yeah. And we would say, be more precise, same value of discount, same amount of cash flow, the further the higher risk. Okay. So therefore, any change has a greater impact on the price of long-term bonds than the price of short-term bonds. Okay, for long-term bonds, a higher portion, every other thing is the same. Okay, a higher portion of their cash flows will happen further in the future, in a more distant time, right? Compared with a short-term bond. Okay, so let's say this. So two bonds. I'll give you two examples. Two bonds, everything the same. Coupon rate, same risk, and same. They are all the same, and the only difference is the maturity. Say one bond is a 3-year, 6% bond. The other bond is a 10-year, 6% bond. So which one is more subject to the interest risk? The 10-year one, right? The 10-year one, because the cash flows happen more in a more distant time, right? And the second example, they both are 10-year bond, but one bond has interest rate or coupon rate 6%. The other has coupon rate 5%. So which one is more subject to interest risk? The 5% one, right? Because for the 5% one, a higher portion of their cash flow happen in the in the distant time. Okay, that $1,000. Remember that $1,000 principal. Okay, it happens 10 years from now. But for 6% bond, okay, their coupon payment are higher before the 10 year, before maturity. So they have a higher portion of cash flow happen in the near term compared with that 5%, right? 5% they have low periodic coupon payment and then 1,000. But for 6%, okay, they have a little higher periodic payment in the near term, okay, before the 10 year and at 1,000. So intuitively, we can say, okay, the 5% bond is more subject to the interest rate risk. Okay, all right. And this is a relationship between interest rates and the bond price. Okay, two things we can learn from here. First, there is an inverse relationship, okay, for the two bonds. One is a 3-year bond, the other a 30-year bonds, and they have the same coupon rate, say 7.25%. So we can learn two things from here. First, there's an inverse relationship that we have already talked about, right? Inverse relationship between interest rate and bond price. Okay, when interest rate goes up, bond price goes down. And where is the threshold? It is the coupon rate. When the interest rate is equal to 7.25%, which is a coupon rate, the bonds should sell at par value 1,000. Okay, see the intersect here, and but see the slopes are different, right? The slope measures the sensitivity of bond price to interest rate, or it measures interest rate risk. Okay, if the slope is higher, okay, that means the bond price is more sensitive to the interest rate, right? It's more sensitive. Okay, for a same amount of change in the interest rate, the bond price of the blue one, 30-year longer maturity bond, changes more than the 3-year bond. Okay, that means they are more sensitive to the interest rate. Okay, meaning that they are more subject to the interest rate risk. Okay, so this is the first example I just said. Okay, everything the same, but the only difference is, okay, the maturity, 30 versus 3-year. Okay, and the 30-year bond, they're more sensitive to interest risk. Okay, more sensitive to the slope, steeper slope. Okay, all right. Then let's talk about the bond return, different measures of bond return. There are in our textbook, there are 3 types of return that we can use: current yield, rate of return, or yield to maturity. We're going to talk about each of them and compare the difference. Okay, first we start with current yield. Current yield is annual coupon payment divided by the bond price. See the difference between coupon rate versus current yield? Coupon rate is annual coupon divided by 1,000, okay, face value. But in here, the current yield is annual coupon divided by bond price. Okay, so let's say if a bond is selling at premium, then its current yield should be higher or lower than the coupon rate? Lower. Should be lower, right? Because the numerators are the same, the denominator different. For the coupon rate, the denominator is 1,000 face value. For the current yield, the denominator is the bond price, which could be higher or lower than 1,000. Then for premium bond, the bond price is higher than 1,000. So the current yield should be lower than the coupon rate, right? Okay, we're gonna talk a little more about that in a few slides. Okay, a bond that is priced above its face value is said to sell at premium. Okay, and the investors who pay a bond at premium must absorb a capital loss over the life of the bond. So the return on these bonds is always less than the current yield. What does it mean? Okay, let's look at this chart. Years to maturity. Okay, if a bond, as time goes on, the years of maturity move on this direction from 30-year to 0. Okay, a bond is moving to maturity. And bond price. Okay, let's say the market interest rate doesn't change during the whole life of the bond. if a bond is sold at a premium, okay, this is the price path for the premium bond, okay? It's sold at a premium, so that the price should be higher than 1,000, right? But as time goes on, the price is approaching 1,000. Okay, can you understand that? Because as time goes on, there are fewer payments, okay? And say into the extreme, when the bond is approaching maturity, and that is the time when there is one cash flow, which is the principal, and maybe just one coupon rate, okay? And that is discounted by the market interest rate. And that value is approaching the face value, okay? It's very close to a face value. Same thing for the discount bond. It is sold at discount, but as time goes on, the price is approaching the face value, okay? Let's do this. Let's do a simple example to understand that. Say we have a bond with a 6% coupon, let's say 8% interest rate. Okay, 8% interest rate. And 6% coupon rate. So 60 periodic payments, right? And 1,000 face value. Okay? And let's say it's a 30-year. Since the market interest rate is higher than the coupon rate, so this bond should be selling at a discount. Okay, so there's a 774. Okay, that's its price. Okay, it's discount. Now let's say this bond is approaching maturity. Now it's say not 30 years. Now it's becoming 25 years. 5 years have passed, and we calculate its price. A little higher, right? Ignore this negative. Negative is just direction of cash flows, right? It's a little higher, right? 774. It's a little higher than 774. And 20, even higher. And let's say 5. It's approaching 1,000. And let's say 1. It's becoming very close to 1,000. And at maturity, nothing is uncertain. Everything is fixed. So we know that 1,000 is worth 1,000. Okay? So in the very, very end, I don't know if we can enter 0 here. But OK, yeah, if it's 0, it's 1,000. So that describes this path. Okay, it's discount, but its price is approaching 1,000 as time goes on and as the bond is approaching maturity. Same thing for the premium bond. Okay. So we talk about that because we are comparing the overall return that we get from a bond. Compare that to the current yield. Current yield is what? The return we get from the current interest payment, annual coupon payment divided by the price. Okay, but that's not all the return we get from our holding period of this bond. Okay, the other part of the return we get is from the capital premium, the capital gain. Okay, so yeah.
If you have a bond, let's say the coupon rate is 6%, but it pays out semi-annual, but you're doing the current yield, so you only use that annual. So
Yeah,
you would use
70.
The if it's 60,
60, yeah.
You'll use the 60,
Yeah.
you won't split it in half.
Right.
Okay.
It's annual. Okay. 2 payments, 30 and 30. At the MAP, they're annual. 60 divided by the bond price. Okay. Yeah. So okay. So what we can learn from this chart is, okay, from the capital gain perspective, from the perspective of capital gain, a premium bond always, during his holding period, is always suffering a capital loss. Okay, the price always goes down. Okay, for a discount bond, it's always a capital gain. Okay, the price always goes up. But from current yield, we don't observe that. We don't measure that. We ignore this part of bond return. So current yield is not a standard or a good measure of the total return we get from the bond. Okay, because it only focuses on the current income and ignores the prospective price increases or decreases, the current yield does not measure the total rate of return. Okay, it overstates the return of premium bond and understates the return of discount bond. Okay, because for the premium bond, there's a part of capital loss that we didn't capture here, so we overstate. And for discount bond, there's a capital gain that we enjoy, but we also ignore that, so it understates. Okay. Okay, let's say, look at this question. What will happen to a premium bond as the time to maturity decreases? Assume that you will hold it until maturity. So if a premium bond and time to maturity decreases, you will be willing to selling at a higher price or lower price? Lower price, right? And the yield to maturity increases or decreases. Yeah, we haven't talked about that. Yeah, but in here it stays the same. Okay. Yield to maturity has been fixed when you buy the bond. When you buy the bond at the market value, okay, yield to maturity has been fixed, has been set. Okay, that is the interest rate that makes the present value of all future cash flow equal to its present value or the price, bond price. We will talk about that. But let's say just A and B is correct, right? It's lower price. Okay. If it's a discount bond, then it should be higher price, right? Okay, yield to maturity. It is the interest rate for which the present value of bond payments equals the price. Okay. The yield to maturity is a measure of bond total return, okay, including both coupon income and capital gain. If you buy the bond today and hold it to maturity, your return will be the yield to maturity. Yeah.
Yield to maturity of the bond will be the rate of return on the bond. Is that true?
That's in a special case, it is true. We're going to talk about that. It is true when the market interest rate doesn't change during your holding period. Okay. We will compare both. Okay, compare the difference between the two: rate of return and yield to maturity. That's a very good question. Okay, a bond investor often refer loosely to a bond yield. Okay, as yield to maturity. It's safe to bet that they are talking about its yield to maturity rather than its current yield. So yield to maturity is a more standardized measure of a bond return, okay, because it is a rate that makes present value of all future cash flows, including coupon payment, including the principal payment, to the present value, okay. That is like we have some cash flow fixed in the future, and we are valuing that cash flow. What rate we use in IY in the calculator, we're actually calculating for the yield to maturity. Okay. All right. And one thing I want to add here is yield to maturity is the return that you will get if you hold it actually to maturity. You will get each one of the cash flows in the future. Okay, all of them. Not like selling them before it matures. Then we're going to use rate of return, which is a different term, and we're going to compare them. Okay. Which of the following statements are correct concerning YTM? So consider both. Okay. Interest income and price appreciation. Assume bond is called at the earliest possible date. Now we hold it until maturity. We don't consider is it called or not. Okay, call means okay, the bond issuer, the borrower can buy back those bonds at some pre-specified price. Okay, then we call that bond is not plain vanilla bond. It's a special feature of that one. Did you professor cover that? No, right? It's a special feature. So we can ignore that. YTM is a compounded rate of return. That's correct, right? We are discounting future cash flows, future coupon payment and principal payment to a present value. That's right. YTM assumes all interest payments are reinvested. So that is correct, right? Have your professor talked about this? Reinvestment? The fourth one. All interest payments are reinvested at the YTM. This is right. We will only be able to achieve or obtain a YTM, the yield to maturity, if we are able to reinvest them in the future. Okay, reinvest at the YTM in the future. Let's say, okay, this is a 30-year bond. Okay, and its value is price is valued is worth some money today. We call that bond price. Okay. we are assuming in each period, by calculating the YTM, we are assuming in each period we can obtain that YTM, which is a very tight assumption. Let's assume, okay, in the future, well, all of a sudden, no investment opportunities can exist. Okay, then we cannot invest in those coupons anymore. That means we cannot achieve that future value anymore. In other words, we can't discount those money to a price that's equal to our current bond price. Okay. So from the calculation, we also know. Okay, so if we look at the math, there are 30 payments plus a coupon, plus a principal, right? Principal payment. We are discounting each of those cash flow by the discounting rate, which is the YTM, and also to the power of number of years, right? We're using these numbers because we believe or we assume at that time period, the bond, the cash flow can be discounted or compounded at that rate. If that rate doesn't exist or we cannot achieve that rate, then we cannot use the YTM. Okay, it's a little hard to understand that terminology. Think about this. We are discounting each cash flow in the future by some rate, okay? And by calculating YTM, we are calculating that rate that can be applied to every cash flow in the future, okay? We apply that rate to the power of number of years it is from now, right? And if that rate is not feasible, not accessible, then we can't use that rate to calculate YTM. So that's simple, okay? Right. So the answer is 1, 3, and 4. Okay. The last one you can memorize that if you. I want to give you a more intuitive explanation to that, but it's hard. Okay. Right. Question. Question 10. Okay. Ryan purchased a bond for $980 at the beginning of 2007 and received the annual interest payment of that at the end of each year through 2012. So when the bond is redeemed at face value, okay, compute the yield, okay, the realized return Ryan earned on this bond purchase. Because Ryan held this bond until maturity, right? 2012 is redeemed at face value 1,000. So the realized return is just the yield to maturity. Okay, so right, yield to maturity is a realized return if you hold the bond until maturity. So we can calculate its yield just using the present value function that we can have on the calculator. 5 years, 7 to 12, right? 8, 9, 10, 11, 12. 5 years. The price is $980. Periodic payment 55 and future value 1,000. Okay, so the IOI is 597, which is also the yield to maturity or the realized return. 591. Right, a little difference. What did you get? 591. Okay, yeah.
9, 0.
0 something. Okay, yeah, right. So that's 591. So it's B. Okay, what is the coupon rate for a bond with 3 years until maturity, a price of that, and a yield to maturity of 6%, interest rate paid annually? That's a simple one, right? So just enter number of the year, 3 years, 6% yield to maturity, bond price, don't forget the negative. It should be opposite with the future value. Okay, PMT, calculate for PMT. Approximately equal to 8%, right? The coupon payment is, say it's 80 divided by 1,000. The coupon rate is 8%. Okay. Yes?
So the number 5 that we have isn't
Is not this one?
It's number 6.
Number 6? Okay, sorry. Yeah. Okay. Yeah. Okay, yeah, this is 5. All right. A. assume, yeah. Is it A?
Oh, I think it's mixed up. No, 5 is B.
This is
It's 6.
this is 6. Okay,
6.
sorry. Question 6. Sorry. Okay, is this 11? Assume a bond is currently selling at par value. What will happen in the future if the yield on the bond is lower than the coupon rate? If the yield on the bond is lower than the coupon rate, then the price should be higher than the face value, right? The coupon rate of the bond will increase? No, it's fixed. Coupon rate is set at the introduction of the bond, right? The signing date. And the coupon payment will be adjusted to a new discount rate. The coupon payments still, they're fixed. A par value are fixed, okay, and the price will increase. Okay, there's a D. Wow, that's okay. Okay, the answer is D. All right. So that's yield to maturity. That's the same as the interest rate that we calculated in chapter 5. We have present value, we have future value, we have a PMT, and number of years we calculate for IY, and that IY is the yield to maturity. Okay. But now, rate of return. This is what? This is the return that we can use if we don't want to hold it until maturity. We want to sell the bond at some price in the future, but that is before the bond matures. Okay. So this is the rate of return, the return measure that we use. Okay. We use the coupon we received, okay, plus the price change. It's our selling price minus our purchase price, okay, divided by our investment or initial price, okay, or purchase price, okay. And we can split this ratio to 2 ratios. The coupon divided by our purchase price plus the change in the prices divided by our purchase price. And the first term, we call that what? Current yield, right? Okay. Say we purchase this bond at this price, and during our holding period, say this. Let's assume if this coupon is just for 1 year, okay, annual, okay, then it is a current yield, right? Just 1 period, 1 year, right? But if it is multiple years, now it's different than current yield, right? But let's say it's just 1 period. This is current yield. And the second is the capital gain, the return that we get from the change in the bond price. Okay? So our total return is equal to the current yield plus the capital gain. Okay? That's why we say current yield is not a good measure of total bond return, because it ignores another part of the return that we get, with the return we get from capital gain. Okay. All right. Let's say, okay, current yield. What is the current yield of an annual coupon bond with 6% coupon, 4 years until maturity, and the price quote of 84? A price quote of 84, how do we interpret that? It is 84% of the face value. Okay? So the price of this bond is $840. Okay, 84% of face value. Yep.
We can do 84 and 100, right? It's the same thing. Or no? You know, like price is 84 and face value is 100.
Yeah. The ratio would be the same, right? 84%. Yeah, all 84%. Right. Yeah. That's true. Mathematically, it's true, right? Yeah. What is the current yield? So current yield is annual coupon. So it's 6%. So it's $60. Okay. Divided by bond price, $840. Okay. So that's 60 divided by 840, 7.14%. Right. It's D. Oh, sorry. Okay. I will upload this as same as last time. I will upload the slides to Blackboard. Good to go? Okay. So what is the rate of return for an investor who pays this amount for 3-year bond with an annual coupon payment 60.5% and sells the bond in a year for this amount? Okay. So there are two parts, right? The rate of return. First part is the coupon income. The second part is the price change. So during this 1-year holding period, she gets $65. Okay, $65, and the change in the price is the selling price minus the purchase price. Okay, 65 plus the price change divided by the purchase price. Okay, 53%. Remember, this is the coupon rate. This is a coupon that we received during our whole holding period. In this case, it is 1 year. So the 65 divided by $1,054 is the current yield. However, if we hold it to 2 years, then we're going to receive 2 times 65. So $130 as coupon. So we can put $130 here if we hold it for 2 years. But same thing if this is a price change, right? Okay. Right. Good. So sorry. The answer is A. Okay. 9. Rosita purchased a bond for $9.89, and that had a 7% coupon and semi-annual interest payments. Semi-annual payments. So how many payments? How much dollar does each payment have? 35, and multiply by 2. It's annual payment is 70. Still 70, right? Annual. So she sold the bond after 6 months. So within 6 months, she must have received one payment, 35, right? And earned a total return of this on this investment. At what price did she sell the bond? Okay, so now we have a purchasing price, we have the coupon income, 35, and we have total return. So we can calculate for the selling price. Okay, just plug in the numbers and then there. Okay, yeah. Okay, so the answer is A. Right. Is there any connection between the yield to maturity and the rate of return? Okay. Again, yield to maturity is the return that we get if we hold this bond until maturity, and the rate of return is the return we get if we hold it for some period and sell it before maturity. Okay. Is there a connection between the two? Okay. This is from textbook. Yes. Okay. If the bond yield to maturity remains unchanged during the period, the bond price changes with time so that the total return on the bond is equal to the yield to maturity. Okay. If the bonds yield to maturity, if the market price, I would say market interest rate during this period doesn't change, then the yield to maturity that you calculated when you purchase a bond, okay, it's the same with the total rate of return that you get from your holding period. They are the same. Okay. However, if the interest rate rises during your holding period, then the rate of return will be less than the yield to maturity. Yield to maturity is fixed when you purchase a bond, right? That is the rate that makes all the future payment equal to the price that when you purchase a bond. But rate of return can change with interest rate. If interest rate goes up, you are selling the bond at a lower price, right? When you sell it. That means you are gonna get a lower capital gain than you expected, than when the market interest rate doesn't change. Okay? So it's a lower capital gain. So your total rate of return could be a little lower than the yield to maturity. Okay? Conversely, if the interest rate fall, then the bond will be able to sell at a higher price. So you are able to achieve a higher capital gain. That adds up to the rate of return So your total rate of return should be higher than your yield to maturity. So that's the relationship. Okay. The difference is on the capital gain. Okay. All right. If a bond investor yield for a particular period doesn't change, then during that period, the bond's return equals the yield. Right? The bond return equals the yield. It's not zero. It doesn't increase or decrease intermittent. No, it's equals the yield. Right? Okay. So this concludes the relationship between current yield, coupon rate, and the rate of return yield to maturity. Okay, if this is a premium bond, it's a discount bond. Okay. Okay, let's assume the market interest rate doesn't change during the period. Then, like what we saw in the previous slides, in this slide, if the interest rate doesn't change, then for any bond, the rate of return should be equal to the yield to maturity. Okay? Okay. And this should be, for premium bond, the rate of return should be lower than the current yield. This is what we saw from our previous slide. So for premium bond, during our holding period, we are suffering a capital loss. But current yield doesn't capture that. So our actual rate of return should be lower than the current yield. Okay, here's the capital loss. Okay. And why current yield is lower than the coupon rate? We also explained that, right? Same numerator, but denominator are different. For current yield, the denominator is a bond price. It's higher than 1,000 premium bond. So the current yield should be lower than the coupon rate. So everything is reversed for discount bond. For discount bond, the price increases through our holding period. So we are obtaining capital gain, but current yield doesn't capture that. So our rate of return should be higher than the current yield. And this is simple, right? The denominator are lower for the current yield, so it should be higher than the coupon rate. Okay. All right. Question. All right. Now we talk about yield curve. Yield curve is a plot of the relationship between bond yields and the time to maturity. It looks like this. Okay. That means if a bond, the textbook introduced a special type of bond. We call it a strip. Okay. That means we split each payment of the bond into single payments and calculate for the yield to maturity for each of these cash flows. So that's a better measure. That's a better measure of the actual yield to maturity we can get from each maturity length, right? From this plot, we can say if a cash is received 13 years from now, we should discount that cash flow using a corresponding yield to maturity. Okay, right. So that's also the discount rate that we should apply to a cash flow that we receive in some certain specific point of time in the future. Okay, so that's relationship. Okay, relationship between yield to maturity to time to maturity. All right. Depletes the current relationship between C, right? Bond yields and maturity, right? So if long-term bonds offered much higher yields, why didn't everyone buy them? Okay, this is question from the textbook. See from that, this is usually the case. When the economy is functioning fine, this is usually the case. The return we get from a more distant bond, the distant cash flow, is usually higher than the return we get from a near-term cash flow. Okay, and these are all annualized, right? This is annualized return, yield to maturity. So why don't every investor just buy those longer-term bonds? Okay, there are two reasons. First, interest rate risk. Okay, the longer-term bond is more subject to the interest rates. Their prices fluctuate more with the interest rate because they are more risky. So we require higher return from that. Also, short-term investors can profit if interest rate rise. If you buy a long-term bond, you are fixed to the interest payment of that bond, right? Just during the whole 30-year holding period, you're fixed to that. But if you are invested to short-term bond, okay, when it matures, and you got the money, and you can invest in other short-term bonds, and if in that period the market interest rate rises, you can go into the market and buy a bond that gives you a higher coupon rate. Okay, you can adjust your investment based on the market interest rate. This cannot be done for a long-term bond investor. They are fixed. Okay, the coupon rate are fixed when they purchase a bond. Okay, this is upward sloping yield curve is more common when people expect that the market interest rate gonna be increased. Okay, if everybody believe the market interest rate in the future gonna increase, then we are more likely to just hold a short-term bond and wait when the interest rate goes up, right? Instead of just locking our return using a long-term bond. Okay, so there's two reasons. Okay, first, higher interest risk. Second, buying short-term bonds allows us to adjust our investment based on the market interest rate. Okay. And we have seen this for multiple times, right? Nominal interest rate and its relationship with real interest rate and inflation rate. Okay. So, and using that, the textbook introduces there's a special bond, feature bond. Okay, we call it TIPS. Okay, the real cash flows on TIPS are fixed, but the nominal cash flows, the interest rate and the principal are increased as the CPI increases. Okay, the nominal cash payment we get from this bond is adjusted for the inflation, adjusted for changes in the CPI. Yeah.
Can you call TIPS as a real? Because it's kind of adjusted by itself.
Yeah, yeah.
It's like a
Right.
real.
Yeah, it's like providing you a real, a fixed real cash flow, a fixed real interest rate. Okay, the return you get from the TIPS is not eroded by the inflation. Okay, for plain vanilla bond, we got fixed payments. It's not adjusted for inflation. So if the inflation is higher, the real return we get from bond could be eroded. Okay, right. The risk that a bond issuer may default, so we are now talking about default risk, may default on its obligations called default risk. Okay, companies need to compensate for this default risk by promising a higher rate of return. And difference between the promised yield on a corporate bond and the yield on a U.S. Treasury bond, which is assumed to be riskless, it's regarded by the market as riskless, as a benchmark. Okay, and with the same coupon and maturity is called default premium. It is actual rate of return that investors require by bearing these default risk. Okay, we call that the default premium. Okay. The greater the chance that the company will get into trouble, the higher the default premium. Okay. And the credit rating agencies gave different, credit ratings on bonds issued by companies with different default risk. Okay, they give credit ratings, and one thing we need to know is above what rating is investment grade bonds. Is that BAA for Moody's or BBB for Standard & Poor's? Okay, it's above those. These are investment grade bonds, and below that is a high yield bond or junk bonds. Okay, the difference between the two groups. All right. So which one of these is included in the yield of a bond with a low credit rating, but not included in the U.S. Treasury bond yield? Talk about that. It's default premium. Okay. It's default premium. Assume bond are selling at a premium. Okay, yeah. So the answer is C. Right. For these, I think you can read the textbook. You can have more detailed introduction on these, how we can protect the investors against the default risk. Seniority. So some bondholders, they are more senior when they're claiming the cash flow from the company, from the issuer. When the issuer are paying off debt, they need to pay senior investors, senior bond first before they're paying for more junior bond investors or debt investors. Okay, seniority, security, okay, like a collateral, right? When you're issuing bonds, you are putting aside some of your assets as collateral. In case of default, you promise that you will pay these collateral to the debt holder for their loss. Okay. Protected covenants. These are the covenants that obligates the company to maintain some performance or capital ratio measures. Okay, say if I invest in your company, your debt ratio can't be higher than some number, okay, in the future. Otherwise, you will be regarded as a technical default, and we're going to negotiate. Okay. These are some limits or restrictions that the bond investor or debt investor put on the company. Okay. All right. Not all corporate bonds are plain vanilla. All the bonds we have talked about plain vanilla. Okay. There are no special features. These are periodic fixed payment and a principal payment. But there could be a zero coupon bond with no coupon, just a principal, just one principal, or floating rate bonds. Okay. The coupon payment can be floating, just like tips, right? They can be floating. They are not fixed. Convertible bonds are the bonds that can be exchanged for a certain number of stocks. Okay, that feature that in favor of the bondholder. Okay, when the bondholder, we can decide as a bondholder, we can decide when to convert that bond into stocks. That is usually the time when the stock price is going up, right? So more profitable for our bond investors to actually hold the stocks and earn higher return. So these are different types of bonds. Okay, which of the following would not be considered by investor when buying a zero coupon bond? Current yield, right? Because for zero coupon, there's no coupon, so there's no current yield. So we don't need to care about current yield. Okay. There's still bond price. They're still using a discount rate and yield to maturity, but there's just no current yield. If the coupon rate on an outstanding bond is lower than the relevant current interest rate, then the yield to maturity should be what? Okay. Coupon rate is lower than the current interest rate. Then the yield to maturity should be C, right? Higher than the coupon rate. So this question is a little, what is the current interest rate? Current interest rate is yield to maturity, right? Current interest is the interest that makes the present value of all future cash flows equal to its bond price. But that's also the definition of yield to maturity, right? So yield to maturity should be higher than the coupon rate. Okay. So the answer is hidden in the sentence, the first sentence, right? Which of the following statements is correct for 10% bond that has a current yield of 7%? So 10% bond has a current yield of 7%. The face value of bonds, face value doesn't change. The bond maturity value exceeds the bond maturity value. What is that? Increase the bond price. Bonds internal rate, we didn't talk about this in chapter 6, right? Market value is higher than the price than the face value. Okay, the coupon rate is higher than the market interest rate, yield to maturity, right? So the price should be higher than the face value. Have you learned the internal rate of return? No? Okay, right. It's okay. Right. So answer D. Question. Good. A bond has face value 1,000, 5 years until maturity, and the annual coupon rate 7. It yields 5% currently. By how much will the price change over the next year if the yields remains constant? So we're calculating for two prices. One is price for now, one is price a year from now. So the only difference is the number of years. For now, it's 5 years, and a year later is 4 years. And all other things are the same. So the price decreases by about $15. Okay. Right. Let's see. Okay. Right. If an investor purchases a bond when its current yield is higher than the coupon rate, then the bond price will be expected to. Okay, if the current yield is higher than the coupon rate, then the bond price should be lower than the face value, right? The denominator, right? So the bond price should be lower than the face value. That means over time, the bond price is expected to increase, okay, over time and reaching the par at maturity. Okay. 19. If a 4-year bond, 7% coupon, and 10% yield to maturity is currently worth this amount, okay, how much it will be worth a year from now? It's similar, right? These are similar questions. So 4-year, 3 years from now. Now it's 3 years, and 10% yield, and 7% interest rate, coupon rate, and future value 1,000. A bond at face value of 1,000 has 5 years until maturity, and expect it is the same question, right? Okay, yeah. Which one of the following bonds would be more likely to exhibit greater degree of interest risk? So let's first compare the first 3: 0 coupon 20 years, coupon paying bond 20 years. Floating rate bond 20 years. For the first 3, which one is more exhibit more interest risk? It's A, right? It's a higher portion of those cash payments are in the further distance. Now let's compare A and D. 0 coupon 20 years, 0 coupon 30 years. The longer one, always the longer one, right? So 30. Okay, so it's D. But we don't know B and C, we don't know the answer, right? Between B and C, we don't know which one is more subject to the interest risk. But we know D is the greatest one, okay? If the coupon rate on our outstanding bond is lower than the relevant current interest rate, then the YTM should be, okay. Huh? Did it already? There's so multiple duplicates. Sorry. Okay, higher than the coupon rate. Okay, that's chapter 6. All right. It's not that mathematical. The math part is similar to the chapter 5, but a lot more concept you need to understand. Okay, like the comparison between different types of bond return and the relationship between bond price and yield to maturity, and the relation between coupon rate, current yield, and yield to maturity. Okay, you need to figure out. Okay, all right. Valuing stocks. Okay, any question on chapter 6? Right, good. First, quickly go over these concepts. Common stocks. These are ownership shares in a publicly held company. Okay. How do we buy common stocks? From IPO, the first offering of stock of the company to the general public. But the company may not just issue one IPO, right? So maybe multiple issuance, and they all happen in the primary offering. Okay, these are primary offering, the sales of shares, but new shares by the company. Okay, if that primary offering is the first time, we call that initial public offering. And when do these offerings happen? Okay, it happens in the primary market. It's the market when the sale of new security by the companies happen. Okay, and after its issuance is traded on the secondary market between investors. Okay, secondary market. Okay, all right. Let's go some concepts. So now these are comparison of different values: book value, liquidation value, and market value. Book value is accounting value. Okay, it records the historical cost of all these capitals. Okay, records what a company has paid for its assets less a deduction for depreciation. It does not capture the true value of business, because the true value could be forward-looking, right? It is calculated from an ongoing concern. Okay, a computer is worth more than its current value because the company using that computer to generating future profits, and that is not captured by the accounting price or the historical price. Okay, liquidation value is, okay, see the company go bankruptcy, and now it needs to pay off the debt to the debt holder, and they need to sell these equipments and the assets and pay off the debt. And the liquidation value is what the company could get by selling its assets and repaying its debts. It does not capture the value of a successful going concern. Okay, so when we are valuing a stock, we shouldn't use the first two ones because these are backward-looking. They are the historical cost. They do not reflect the market value of that company and a going concern. Okay, so market value is the amount that investors are willing to pay for the shares of firms. This depends on the earning power of today's assets and the expected profitability of future investments. Okay, and this is what financial analysts and stock investors care about when they are valuing a stock, their future profitability, profit earning ability. Okay. So the difference between these two comes from these three sources. Okay, extra earning power. Okay, historical cost is not equal to its earning power. Okay, earning power could be higher. Intangible assets, the intelligence, the expertise, its experience, the management team, these are all intangible assets that has considerable amount of profitability, profit earning ability. And these are not measured by the book value or liquidation value. The value of future investments, these are not captured by the historical cost, right? These are future investments that haven't happened yet, but stock investors and analysts may forecast that and give a value to that, to the stock price. Okay, and all these are considered by included into the market price. Okay, a successful company ought to be worth more than the book value or liquidation value. And okay, these are the two. So the question is how to value, how to get that market value. Okay, financial analysts use comparable company approach that look at the price of comparable companies and get a value for this company that we are interested in, using these ratios: market to book ratio, price to earning ratio. Okay, so these are these are the representative companies in each industry. Okay, if you believe these ratios are correct for industry as a whole, then you can use those ratios from the industry or the comparable firms to get the ratio for this company that we are interested in. Okay, so if the industry has a 2.2 market to book ratio, then for FedEx should be similar. Okay, and we can use that to determine the market value, market price. Okay, that's a comparable firm approach, but the focus in this chapter is still discounting cash flow approach. Okay, we're looking at the intrinsic value, or the present value of future cash flows we get from a stock, and these cash payoffs are what? Are dividends, right? How do stock investors get the return from the dividend? Price appreciation and depreciation also reflects the present value of future dividends. Okay, so the fair value or intrinsic value is just the present value of future dividend plus the future selling price, then discounted. Okay, that's the value of any stock or security. Okay, right. So we're essentially discounting this cash flow. Same thing, right? The future dividend we are gonna get, and the future selling price. Okay, we're discounting that. This is a simplified equation. Okay, discounting future cash flows. Now 28. Suzy owns 100 shares of AB stock. She expects to receive, it's not 280, it's 238, it's 2.38, okay, 2.38. So there's the point missing. My apology, 2.38. Okay, sorry. Yeah. In dividend next year, the investor expects the stock to sell for 46 a share a year from now. What is the intrinsic value of the stock if the dividend payout ratio is this and discount rate is this? Okay. We do not actually use dividend payout ratio, right? What is dividend payout ratio? Yeah.
Profits that you pay as dividend.
Right. Yes. The percentage of the profit, well, we can use the earning per share, right? We get the percentage of earning per share that's paid out to the stockholders. Okay. Right. And 1 minus payout ratio is what we call the plowback ratio, right? Plowback ratio is a percentage or the portion of earning that's plowed back to the company and make future investments. Okay. But we are not actually using that in this case. We're just using this. Okay, we got this amount of dividend plus this is the future selling price. Okay, 46, and divided by 1 plus the discounting rate, 13.5%. And that is the intrinsic value or the fair value or the fair price of this stock. Okay. The answer is B. A stock paying $5 in annual dividend currently sells for $80 and has an expected return of 14%. What might investors expect to pay for the stock a year from now after the next dividend has been paid? Okay, so same thing. Okay, so now it is worth $80 and it's paying annual dividend $5. We're holding it a year. We're holding the stock for 1 year, so $5 dividend. And a year from now, this is what we are calculating for. And we are expecting 14% return. So a year from now, the price should be 86.2. Okay. Right.
So 83% the present value?
80,
DO?
86.
No, I mean 80 means based on the formula DO or present value?
What is present value? The 80?
Uh-huh.
The 80 is present value. Yeah, that's true. Yeah, right. Or fair price, present value, same thing. Yes. Yeah. Okay. So expected rate of return. So that R. Okay, that R. What is that? Now, what is that? The expected rate of return. It comes similar from two sources. One is from current income, similar as bond, right? The expected return of a stock is expected dividend yield plus expected capital gain. So see, this is kind of familiar, right? So dividend we get in the next period, or whole year, not in the period, the whole year, plus the price change, depreciation or appreciation divided by initial investment. And we split the ratio into two ratios. The first part is the expected dividend yield. The second part is expected capital gain. Two sources, right? From the current income, from the price change. Okay. Now, okay. What dividend yield would be reported on the financial price for a stock that currently pays $1 dividend per quarter, and the most recent stock price was $40. So $1 per quarter, so $4 a year. So annual dividend $4 divided by 40. So dividend yield is 10%. Okay. For current yield in the chapter 6, we're using annual coupon. In here, the dividend yield is annual dividend. They're all annual, divided by either bond price or the stock price. Okay. A bond currently sells $50 per share. Expected return 15%. and expected capital appreciation rate of 10%. Capital appreciation rate is just the capital gain, right? So selling price minus purchase price divided by the purchase price, capital gain rate, 10%. What is the amount of expected dividend? Okay, so the expected rate of return is 15%, and the rate we get from capital gain is 10%. So this is current yield. Annual dividend divided by the bond price. Stock price, $50. So the dividend should be $2.5. Okay. Good. Good. All right. Okay. Discounted cash flow model. We are using discounted cash flow model to find the stock price. Okay. Today's stock price equals the present value of all future expected future dividends. Okay. Previously, we're using price appreciation, depreciation, right? But essentially, a stock is worth some money because the investors believe they will receive dividend in the future. Even though we can sell it before, okay, a stock never matures, but we can sell it at some future point of time. But that selling price also comes from the promise or the belief that further in the future the stock gonna pay dividend. That's the cash flow from the stock, okay, and those dividends is worth some value. And the dividend. This dividend discounted cash flow model just price a stock using the present value of all these future dividends. Okay, but since a stock never matures, we can expect that they're gonna be infinite times of cash flow in the future, but we still need to discount that and calculate for the cash flow, right? Present value. Okay, let's first assume, okay. This is perpetuity, meaning that we are receiving an equal amount of cash flow for each period, and it's go on forever. So it never ends. Okay. Then the price of that stock should be periodic dividend divided by the interest risk, or the expected return. Okay. Expected rate of return offered by other equally risky stock, comparable stocks. Okay, or the expected rate of return required by the investors on this stock. Okay, this is essentially a perpetuity, right? So what would be the price of stock that offers this annual dividend with no prospects of growth and has a required return R of 12.5%? So it's pretty simple. Annual dividend 4.32 divided by the R. Okay. Good. Right. So it's C. What should be the price of stock that paying this annual dividend if growth rate and discount rate is 8%? Same thing, right? 3.5 divided by 8%. 43.75. D. These are all annual dividend, see? So this is annual dividend divided by the annualized rate of return, okay? Now, the coupon is not fixed. It grows, but it grows at a fixed rate, say several percent, 2%. The future coupon, the future dividend grows at a constant rate of some number, okay? Then this is the function that we use to calculate for the price, okay? Dividend is the next DIVY dividend is the next period's dividend, okay? It's the next dividend divided by the required rate of return minus G is the growth rate of the dividend growth rate. Since it's constant, G is equal to some constant number. Okay, we call that constant growth dividend discount model, or the golden growth model. Okay. Golden growth model. Okay. Which of these statements are correct? Is correct. Okay. So this is from the textbook. So dividend, for some case, for some firm, if dividend is not feasible, we can use free cash flow. Okay, in these questions, it's simple. Let's say these are just, I don't know if your professor taught you this, but if they didn't teach this, we can briefly just skip that. If a firm don't pay dividend, but they repurchase the stocks, they are paying the stockholders, like they are buying back the stocks. That's essentially another form of paying dividend. They are kind of equivalent. So for these cases, we can't use dividend because there's no dividend. Alternatively, we can use a free cash flow, okay, that we learned from chapter 3, 4, right? These are, so we can memorize that. This is definition. It's available paid out to investors as interest or dividend, or to repay debt or buy back stocks. That's the definition. And in this case, we're using free cash flow. But if you have learned this, let's say this is just a dividend, okay? A firm has this amount of shares of stock outstanding, and the sustainable growth rate of 3.8%. Sustainable growth we're going to talk about, but that's just a G, right? That's just a G, 3.8%. And the free cash flow of this amount, in next year's free cash flow, what value would you place on a share of this stock if you require 14% rate of return? First, free cash flow per share is, okay, the total free cash flow. Let's say total dividend divided by number of shares. So that's the dividend per share, 5.4, okay? That's the next dividend divided by the required rate of return minus the constant growth, sustainable rate of growth, 3.8%. So it's 52.96. Remember, this the numerator, the dividend, is the next dividend. Okay, it's next year's free cash flow or next year's dividend. It's not the most recent one. It's the next one, okay, that you're going to receive in the next period, one period from now. So it's B. What is the required return for a stock that has a constant rate of 3.3 and price of $25 and expected dividend of that, and P ratio 14.4%? Okay. So we're not actually using the P/E ratio. Okay. We got all the variables we need to calculate for the required rate of return. So 2.1 is expected dividend, the next dividend. Price is 25, and G is 3.3%, and R is 11.7%. Okay. Yeah.
R in order to replace 25.
Right. Yes. So move this R, move R minus 0.033 to the left, and divide 2.1 by 25. Okay. Yeah. All right. Question. This. And this is just to confuse. Yeah, just to confuse you. Yeah. Okay. What should you pay for a stock if next year's annual dividend is forecasted to be 5.25 constant and you require? Okay, these are all similar, right? P is equal to next dividend divided by R minus G. It's kind of similar. C. Right. Okay. Next one. Sustainable growth rate, which is the G. Right? How do we calculate for G? Right? How do we determine that? It is the firm's growth rate. If the firm plows back a constant fraction of earnings, we call that a plowback ratio, or a constant plowback ratio. Okay. Plows back a constant portion of their earning or earning per share back to the company. Okay, maintain a constant rate, or a constant return on equity, constant ROE, right, and keep its debt ratio constant. Okay, the ratio between debt to equity are the same, or debt to asset are the same. Okay, and the growth rate that we obtain from that is sustainable growth rate. Okay. Just a review of the definition. A payout ratio is the portion of earnings to be paid out as dividend. It is equal to 1 minus a plowback ratio. Plowback ratio is a fraction of earnings reinvested in the firm. And we call that retained earnings, right? Or payout ratio is 1 minus plowback ratio. So the dividend is just what? It's just earning per share multiplied by the payout ratio, or 1 minus the plowback ratio. Okay. And what is earning per share? Earning per share is just book value per share multiplied by ROE. Book value is book value equity, right? Book value equity multiply return on equity, and that's a per share base. So that's earning per share. Okay. So then, this may be a little complicated, but what we can get from that, the growth rate of dividend is just the growth rate of book value of equity if ROE is the same and plowback is the same. Right? That's what this sentence means. It's a firm's growth rate if it plows back a constant fraction of earnings. Plowback ratio constant. And the return on equity constant. Return on equity constant. And also debt ratio constant. So it's a proportionally to the increase in the total size of the firm, right? If this is constant, and that is constant, then the growth rate of dividend, which is G, is just a growth rate of book value of equity, right? So now if we calculate for that, we can get the growth rate of dividend. Growth rate in book equity is equal to plowback earnings divided by initial equity. This is from textbook, so I don't know if you have covered this, by your lecture. No, by professor. But okay, we can skip that. But you have to know this, right? This equation you have to know. G is a sustainable growth rate. The growth rate of the dividend, which is also the growth rate of the book equity. Okay, plowback ratio multiplied by ROE. Okay. Right, and then we can use that to do questions. Earning per share, this, and the dividend per share is 0.35. What is the sustainable growth? It was G if return on asset is this, return on equity is that. Okay, earning is that, and dividend is this amount. We can calculate for the payout ratio or plowback ratio, right? Plowback ratio is just the total earnings, 2.98, minus the dividend, okay, 0.35 divided by the earning per share. That is the plowback ratio, the portion of earning that is plowed back to the company. And G is just ROE, and it's not ROA. It's ROE here is to confuse you, but we are using ROE multiply the plowback ratio. Okay, that's G. Good. All right. All right, next one. It's D. A company with ROE 15% and plowback ratio 60% would expect, so we just multiply the two, okay? ROE and plowback, okay, 0.9%. Sorry, so 9%. There's no zero here. All right. Non-constant growth, okay? So the dividend, so this is usually for some growth firms. So constant growth is usually for some mature firms. Okay, they are established. We don't expect them to be growing like a surprisingly high rate, and dividend should be constant or constant growth. But for some growth firms, their dividend is highly unpredictable, or we can just predict their growth rate period by period. Okay. So this is a time when sometimes we need to use a complex cash flow function on the calculator, right? Because their cash flow are not following a certain pattern, and we need to calculate them individually. Okay, so stock price equal to the present value of dividend, and plus present value some stock price at some horizon. Okay, terminal value. Okay, let's look at this. This is not that complicated, but still it is a non-constant growth model. Okay, the ABC common stock is expected to have an extraordinary growth in earnings and dividends, 20% per year for 2 years, and after which the growth will be settled to a constant 6%. Okay, if the discount rate is 15%, the most recent dividend is 2.5, which should be the appropriate share price. Okay, share price should be the present value of all future dividend, but the future dividend are increasing at non-constant rate. Okay, so if we draw a timeline, say, okay, this is T0, T1, 2, 3. Okay, the most recent dividend is 2.5. We don't actually use that, right? Any dividend discount model are using the next dividend, but we can use that as a start to calculate for the next dividend. It increases at 20% per year for 2 years. So that is the 2.5 multiplied by 1.2, which is equal to 3. Is it 3? Yes. 3, okay. And okay, the answer is there. So 2.5 multiplied by 1.2 and another 1.2, 3.6. Okay? And starting from that, it increases for 20% for 2 years. And then it will settle into a constant of 6%. So starting from the second year to the third year, it's going to be increasing at 6%, 3.6 multiplied by 1.06. And then it go on forever, increasing 6% per year. Okay, 6% per year into forever. And now we're calculating for this price. So there are many methods to do this question, and I will talk about mine, and you can raise if you have alternative method to do that. So in this case, there are 2 payments at very beginning, okay, 3 and 3.6. And then it's a Gordon growth model, right? Constant growth into forever. It's constant growth. Then we can calculate the value of that perpetuity into the future as of here. Starting from here, the dividend is increasing at 6% into forever. So the present value at t equal to 2 for all these cash flows into forever is 3.8016 divided by the discount rate 0.15 minus 6%, right? That is the value of the perpetuity as of t equal to 2. And then we have this value, and this value, and this value. That is equal to how much? 42.4. And this value, 3 value. Just discount them to a present value. And this is just that. Right? 3 discounted by 1 period, 1 plus 15, plus 3.6 and 42.4 divided by the discount rate for twice. Okay, and that is the present value of all these cash flows. Okay. Right. I didn't use like a financial calculator to do that because it's just 2 periods. It's not worth to use the complex cash flow method to do that. So this is just, you can just using the simple calculation. Okay. All right. Question?
Why do you agree on
Which one? 3 point.
Yeah,
This one? 3 point. Yeah, that is the next dividend. Next dividend.
so 3 years, you put the fourth one over there?
3 years.
You put the fourth one?
So you see, so you're thinking that, so the dividend is growing at 6% starting from when? Starting from here. Starting from here to here. that is the first period of 6% growth rate, right? You can also calculate that. Yeah, you're right. If you use like a 3 to 4, you can also use that, but you have to add. You are calculating for the value of perpetuity as of here, but you're missing that. But you can also add it back, okay, and calculate for this and the value of cash flows for 4 years and beyond, and plus that and that, discount them. Same thing, but this I think is simpler, because this is one part, is actually the first dividend when the firm is growing at 6%. That's the first dividend. Okay.
Second year, 2.5, not 3. For second period.
For the second period.
Yes, yes.
Because that is still, it's growing at 20%.
Use the 3, use
Right.
2.5, right.
Yeah, yeah. Yeah.
Professor, if a 2 is just ordinary annuity discounting. If it's a 3, it would be annuity to do a discounting.
Oh, this is, yeah, if you are thinking about,
Yeah.
Okay, yeah.
Just to remember that way easier, because it's
Yeah.
easier from 2. Right?
if you were, yeah, 2 periods, right, this it's also a, if you're looking at the annuity deal, it's also correct. But that's why I say there are multiple periods, multiple ways to do that, right? It depends on what you are more comfortable with. Your question is?
Right here, you took 3 and 4 and 6, and for second period we did the same. 2.5, not 3.
2.5.
Yes, but not 3. First period. And yes, not this.
Do you understand that?
Yes.
And do you understand this? No.
Yes, but why?
Why is it become different? Why? So that is your dividend you received in your second year. The dividend you received in the third year is that amount increased by 6%, and that, right, and that. And
Second doesn't increase like this, right?
for the second, it's because it's it's 20% increase rate. Yeah. Now it's a 6%. So increase rate. So the growth rate 20, 20, 6.
Consult the calculator.
The calculator.
Yeah.
This is, but I do this using calculator. But if you are using, okay, if I see what you mean. You want to plug in those numbers. Complex cash flow, you want to do it that way? I think it's even harder. So there are, okay, let's simplify the whole question. So there are 3 cash flows. One is 3 at the end of the first year. Second, 3.6 at the end of the second year. The third is 42.4 at the end of the second year. There are 3 cash flows, but they happen at 2 points of time. Okay, and then if we don't want to do these calculations, okay, let's do complex cash flow. Okay, so at t equal to 0, there's no cash flow. We ignore this 2.5, okay? Yeah?
Yeah.
Good, okay. And on the first cash flow, it is 3, right? Just 3. Enter, and down, it is just for 1 period.
But why you don't count 2.5?
2.5 is the previous one. We look at the next one. You can see it is being paid, right? Most recent one. Most recent one, we ignore that because stock price is all forward looking. And the second is how much is 3.6 plus 42.4, right? It is that number. Is it? Yeah, okay. Enter and down, and just for 1 period. Okay, there's no CO3 anymore. NPV and interest rate is 15. Enter, down, calculate. Is this right? Okay. All right. Okay. These are the two methods. You can choose. You can pick the one you're more comfortable with. All right. Okay. Okay. Any question? Do the calculator again. I'll quickly do it. Okay. So.
Why is it 0 there, but we do 2.5 on the other?
2.2. There's no 2.5. 2.5 is the most. It's in the past. Stock price. The stock price includes only the information about the future, the future cash flow. Okay. So we don't like 2.5. Okay. So start from CO0 is no. There's no 2.5. It's 0. It's the most recent one is in the past. We don't look at that. So let me clear memory. Okay. 3 is the first cash flow for one period. Second is 3.6 plus 42.4. Enter. Down is also one period. Down. NPV. 15. Enter. Down. And calculate. Okay, the answer. All right. Question? All right. So that's this one. Plow back earnings into new investments may result a growth in earnings and dividend, but it does not add to the current stock price if that money is expected to earn only the return that investors require. Okay. Plowing back earnings does add value if investors believe that the reinvested earnings will earn a higher rate of return. That means what? If the company reinvest the money with a expected return that's just equal to our expected return, required return, then that reinvestment doesn't increase the stock price. Okay, it will only, so you want to say sometimes the firm promise you, okay, so in this period we don't pay you dividend. That is because we want to reinvest and grow and give you a higher return in the future. Higher return in the future, right? It's not the same return in the future. If they only give you a same return in the future, then what's the point of reinvest? Okay, they should just give the money. Give you the money right now instead of keeping it. Okay, it will only achieve a higher stock price in the future if those reinvestment can earn a higher return than what we actually require. Okay, so this is intuition, but this is math. Just in case you are interested in it. All right, I'll skip it. Okay, let's just look at the very beginning and the very end. If there is no plowback, price is just the earning per share. They pay everything to you, all their earning per share to you, okay, divided by R. No plowback. See, plowback is 0. They're all 0, okay. If there's some plowback and a positive ROE, return on equity, return on the investment, ROE greater than R, then the price should be greater than the P0, what we get from no plowback, okay? Intuitively, if there's a positive plowback and ROE greater than R, stock price should be greater than the stock price when there's no plowback. If there's positive plowback, but we are just able to earn an ROE that's equal to R, then the price is just equal to the stock price when there is no plowback. Just don't plow back. This is, okay, so to make it simpler, if the company is only able to earn return that is just equal to our required rate of return, then please don't plow back. Pay everything to us. Okay, P0 should be equal to, P2 should be equal to P0. Okay? Well, you can read the equations after the class if you're interested, but that's the intuition, okay? Right? The present value of growth opportunities is the net present value of a firm's future investments. Okay, total value of stock includes two parts. The current value of all the assets in place plus the value of future investments. Okay, so it is so P1 is the actual total value. P0 is if there is no plowback. Okay, pay everything to you. Don't make future investment. We don't want a future investment. Don't reinvest anything. To pay EPS, earning per share as dividend divided by R. Okay, that is the value of assets in place, plus the value of future investments. Okay, and that is the PVGO is the P1 minus P0. It is the stock price when there are positive plowback, okay, minus the stock price when there's no plowback. Okay, plowback means future reinvestment, right? So that's PVGO. The value, the stock value, the portion of stock value that comes from the future investment. Okay, let's look at this. Which of the following situations accurately describe a growth stock assuming that each firm has a required return of 12%? For a growth stock, the investment opportunity should yield a return that is at least equal to, at least higher than the required rate of return so that the firm can grow, right? So the answer is C. Investment opportunity must yield a return that's higher than 12%, okay? And in that case, the PVGO is positive. Okay, there's a positive value from future investments. What is most likely PVGO stock with a current price of 50? Expect the earning of $6 earning per share and required return of 20%. Let's look at this. So the PVGO is the difference between the actual stock price, okay, minus the stock price if we assume the firm doesn't plow back anything. If the firm pays out all their earning per share as dividend to the stockholder. That's 6 earning per share divided by the required rate of return, 20%. That is the stock price if the firm doesn't plow back anything. Pay $6 as dividend. And that is actually just equal to the earning per share. They pay all their earning to the stock price, to the stockholder, and divided by the required return, 0.2. Okay, that's 30. The 50 minus 30 is the value of this plowback, and also the value of future investments. Okay. Right. Question? So the answer is B. Yeah.
We see P1 minus P0, P0 divided by R.
P0 is equal to earning per share divided by R. In this case, earning per share is just the dividend. That is what? That is just no plowback, right? P0 is equal to earning per share divided by R. Okay. So if the firm doesn't plow back anything, the firm doesn't grow. So keep that same size as keep that size of asset constant in the future, so that it pays constant dividend in the future, and that dividend is all their earnings in each period, which is earning per share. Market value balance sheet. We all know that balance sheet are accounting value, is historical value. But based on what we talk about, the market value, we can also create a market value balance sheet. And all these assets are all market value. And we can add a growth opportunity in the PVGO here to get a total value of assets. Okay, these are the market value of assets. They're also the value if we don't reinvest, we don't expand. And from the reinvestment or expansion, we can get the growth opportunities, present value of future investments. Okay. then these are just all conceptual things. You can read the textbook. I don't think you have learned too much about technical analysis. That's not the focus of this class. That's when investors want to figure out the future stock movement based on the previous stock movement. Just from the stock price changes, they want to capture future mispricing. Okay, but however, for most of the stock price follows a random walk, meaning that stock price change randomly with no predictable trends or patterns. It's like a drunk man walking down the Wall Street. We don't know where he is going in the next step. It's a random walk. Price appear to be wander randomly. They are equally likely to offer a higher or lower return on any particular day, regardless of what has occurred on previous days. In other words, price seem to follow a random walk. Okay. That means in most cases, technical analysis is not working very well. Okay. And alternatively, many people or analysts and investors are using fundamental analysis. They attempt to analyze the economy or the industry or the firm, their fundamentals to figure out mispricing of stocks. Okay. Investors who attempt to find mispriced stocks by analyzing fundamental information such as accounting performance and earning prospects. I think this is what Buffett is doing, right? He believes in fundamental analysis. Okay. Economists often refer to the stock market as efficient market, meaning that there are so many fundamental analysts, so many analysts, investors focusing on each individual stock and also stock market, so that any mispricing has already been figured out, recognized, and has been traded, so that they don't exist. Okay, this is efficient market hypothesis. Okay, by this they mean that the competition to find misvalued stocks is intense. So when new information comes out, investors rush to take advantage of it and thereby eliminate any profitable opportunities. Okay. Okay, so if you believe in fundamental analysis, you have to realize that in many developed economies, the efficient market hypothesis usually holds. Okay, it's very hard to find mispriced stocks. Okay. However, there are also many market anomalies that violate the hypothesis of efficient market. Say earning announcement puzzle. So after the earning announcement, firms issue their financial report. Good news or bad news? In theory, investors should react to that news simultaneously and instantly and eliminate that profit opportunity. But in reality, that profit opportunity can last for months, even a year. So that's a puzzle. Why the investors don't react completely to that news? It seems that they have some underreaction to these good news or bad news. Okay, or new issue puzzle. So IPO, like investors rush through the IPO stocks and believe that they can earn an extraordinary return. But in reality, if you look at the 5-year horizon after the IPO, those IPO investors usually suffer a loss. Okay, compared to their comparable portfolio. Bubbles and market efficiency. There are many bubbles we have seen in the past 20 or 30 years, right? Dot-com bubble, the tech bubble, and also the real estate bubble before the financial crisis, right? These are all violate the efficient market hypothesis, meaning that they deviate from the fundamental, and they are all mispriced. And there are researchers attribute those to behavioral finance, saying that all these investors and analysts and people are not 100% rational and at 100% of time. They are subject to their risk preference, their recognition risk, and all type of irrational behaviors, either emotional or cognitive. So if your professor have taught these, I recommend you read the textbook and memorize all these concepts. Okay, and that's all for today.